After the summer rally on Wall Street, which looks like a classic bear market bounce, the stock market's certainly entering the scariest months of the year, September and October, at a very interesting time. Federal Reserve, unless they plan on another $5 trillion worth of stimulus dropped out of the sky, it looks like they might be on the Reflation Tour of 2023 if they were a rock band. Question for the Federal Reserve. If our GDP, our economy is worth about $30 trillion, and we dump $5 trillion into it basically overnight, shouldn't inflation have been and still be at around 15%? And finally, some good news in housing. Fannie Mae and Freddie Mac have raised their conforming loan limits, creating another level of support for the housing market. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. Okay, well, the summer rally is over, and it looks like a classic bear market bounce, classic bear market rally on Wall Street. And here we are in the middle of September, headed into October. Typically, traditionally, one of the scariest months historically for the stock market. We're going to see how this shakes out. But I do know this, yields on treasuries, 10-year treasury right now, hair under 350. Yields on treasuries are actually, for investors, looking very attractive, again, given what's going on Wall Street. So if the stock market continues to sell off and our economy is working how it should, when people sell their stocks, they should be buying bonds to park their money at a pretty attractive yield right now. So from there, if stock market continues to go down, I bet you interest rates will go down. And last night, we actually had one of the two largest shipping and logistics companies in the world come out with some terrible, terrible earnings and some miserable guidance, so bad they couldn't even give us guidance. And let's use this as a bellwether for the economy. And they actually said they're worried about the global economy, and they're going to be a great bellwether for this because they are involved with every single thing that goes on globally in our global trade. So it looks like if that's any cue from a huge shipping and logistics company, looks like the recession's been here for a while. Moving on to the Federal Reserve, like I said, unless they're planning on another $5 trillion worth of stimulus to be dropped into the economy, they really definitely need to relax. Because like I mentioned maybe last week or a couple weeks ago, this is the controlled demolition of our economy, and they're doing a good job with that. Here's a note for them. We dropped $5 trillion, like I keep talking about. They were right when they said inflation was transitory because they had the idea when they said that. Everybody thought they were wrong when they went to the gas pump, but they were actually right, the Federal Reserve. I wish they would have stuck with their attitude there. But they're going to understand, and we've got to understand, inflation's going to be artificially high for a couple of years after you drop $5 trillion into the $30 trillion economy. This $5 trillion is probably going to take a year or two to work its way out of the economy on an inflation measurement basis. And we are nowhere near 2 years after the last bit of stimulus was thrown into the economy. So the Federal Reserve knew it was transitory. They just didn't have the nerve to stick with it and stick to their beliefs, knowing very well knowing they know it would take time for the stimulus to work its way out, and they didn't give it a chance, and they artificially raised these rates way too high, way too fast. That said, the Federal Reserve, as we talked about last week, still hasn't seen the effects of maybe now seeing the effect of one rate hike that they did, but certainly not the last few bigger rate hikes that they did. But let's use the U.S. mortgage market as an example. We got ahead of what the Federal Reserve was going to do, through the end of this year, right at the beginning of this year. And if the reaction from the mortgage market is any indication of what the reaction is going to be from the rest of the economy that's going to deal with the higher interest rates moving in, it's not good. They really should have seen it through. They knew it was transitory because they knew it took time to work. The stimulus took time to work its way out of the economy. They didn't give it enough time, and now they've started raising rates into the face of a recession, and that's a tough thing for them to do. It's quite a parlor trick, as some would say. All right, and then when it comes to inflation measurement itself, I said this last week. They really need to take housing, which they're going to call shelter now. Take shelter, and I actually like that term better from what I'm about to say. take shelter out of the inflation numbers just like you do food and energy, because shelter itself is a utility upon itself. And as we know, there is a shortage of shelters, meaning housing, because as we always discuss, not as many homes and dwellings have been built in the last decade or so. So I believe that they do need to take housing/shelter out of their measurement when they are gauging inflation. A couple notes on the economy in general. It's definitely easier to slow down an economy than it is to speed it up, because the Federal Reserve can, of course they can raise rates, but they can also talk the economy down. And as we've seen, the biggest spikes in 10-year Treasury yields and Treasury yields happens not after they actually raise rates. Yields actually go down most of the time this year after they raise rates. It happens when they come out and talk rates up, and the most famous talk up was recently in Jackson Hole a few weeks back. So it's really easier to slow it down than it is to speed it up, and they need to really put the brakes on what they're doing. And I mentioned this, if the economy in general is worth about $30 trillion and we've got $5 trillion worth of stimulus, if I was them, I'd be worried that we didn't hit 15 to 17% inflation and that the economy is actually lagging with all that stimulus in it, because that's, in some estimations that you can look at, should be 15% inflation, not what we have today. And a couple other things here. Too many economic numbers we're getting right now seem, sound, and feel like 2007 and 2008. We all know what happened then. Nothing good. And some of the numbers we're getting right now are hearkening back to there. And it looks like our economy, as I've talked about in the past, it's a boom to bust cycle. I wish we could just have a self-reliant economy. I do believe the Federal Reserve needs to leave the arena when it comes to inflating prices with their stimulus, so to speak. And right now, the patient is coming off of all that sugar high, and we need a self-reliant economy. It's going to be some time till we get there, until the Federal Reserve is out and just on the sidelines again. We'll see how many years that is. And again, if you're the Federal Reserve, I'd start printing those T-shirts for the Reflation Tour of 2023 as if they were a rock band, because I have a funny feeling that the economy is going to get out of their control to the downside, and they're going to have to be reflating it sooner rather than later. All right, moving on to the real estate and mortgage markets. Good news, Fannie Mae, Freddie Mac have raised their conforming limits for 2023. This is obviously a lot of support for the housing market. To give you some indication, it's north of $700,000 now, a conforming loan in most areas. When I started in the business in 2004, that number was less than half, $330,000. So if you're wondering why housing prices have doubled, this is why. Fannie Mae and Freddie Mac are the underlying support for the whole housing market economy. And as we discussed, inventory is way up. That is to be expected. All the sellers that felt like they missed out on the top dollar at the top of the market are now, I'm not going to use the word flooding necessarily, but they're very active in getting their homes listed. And confidence and sentiment, which I believe at the end of the day are basically everything, could get worse when it comes to housing. These rates have been higher for longer now. Affordability is in question, and housing confidence and sentiment are very weak right now. Hopefully something happens to stimulate that, a little bit of a drop in rates maybe. But I can tell you this, great time to be a buyer, probably the best time to be a buyer in the last few years, if you're dealing with a realistic seller. Okay, everybody, that is my show for this week. As always, thank you for watching. If you have any mortgage-related questions, please don't hesitate to reach out to me. Please have a great, safe weekend.